Question 1. What is the primary function of an insurance policy's insuring agreement? A. Outlines the premiums to be paid by the policyholder. B. It details the insurance company's obligations and the coverage provided. C. It lists the exclusions and conditions that void the policy. D. It specifies the policyholder's rights to terminate the agreement. Answer. B. It details the insurance company's obligations and the coverage provided. Explanation. The insuring agreement is the section of an insurance policy that outlines the insurer's basic promise of coverage. It specifies what perils, losses, or risks the policy will cover. This is central to the insurance contract as it sets out the obligations of the insurer, which typically include the insurer's duty to provide coverage for specified risks, as well as the limits and terms of coverage. Option A is incorrect because premiums are addressed in the declarations section, not the insuring agreement. Option C refers to exclusions, which are typically found in the exclusions section, not in the insuring agreement. And option D deals with the termination clause, often found elsewhere in the policy but not under the insuring agreement. Question 2. Mr. Richards has a workers' compensation insurance policy that includes a $500 deductible. He files a claim for medical treatment that costs $2,000. How much will Mr. Richards receive from the insurance company after the deductible is applied? A. $2,000. B. $1,500. C. $1,000. D. $500. Answer. B. $1,500. Explanation. When a deductible is included in a workers' compensation policy, the policyholder must pay the deductible amount before the insurance company begins to cover the remaining costs. In this case, Mr. Richards' deductible is $500, which means the insurance company will pay for the remaining $1,500 after the deductible is subtracted from the total claim amount. The calculation is $2,000 total cost of treatment, $500 deductible equals $1,500 amount paid by the insurer. Option A is incorrect because the deductible reduces the payout amount. Option C is incorrect because the insurer pays $1,500, not $1,000. Option D is incorrect because the $500 deductible is subtracted from the total not paid as a separate payout. Question 3 scenario. Mr. Thomas is a small business owner who has a commercial property insurance policy. He recently suffered damage to his office building due to a fire caused by an electrical malfunction. Mr. Thomas submits a claim for the damage, which totals $25,000. The policy includes a $1,000 deductible and covers damage based on replacement cost. What amount will Mr. Thomas receive from his insurer? A. $25,000. B. $24,000. C. $26,000. D. $24,500. Answer. B. $24,000. Explanation. In property insurance, when a deductible is applied, it is subtracted from the total amount of the claim before the insurer pays out. Since the policy is based on replacement cost and not actual cash value, the insurer will pay the full cost to replace the property minus the deductible. The total cost of damage is $25,000 and the deductible is $1,000. Therefore, the insurance payout is calculated as $25,000. Claim amount $1,000. Deductible equals $24,000. Amount paid by the insurer. Option A is incorrect because the deductible reduces the payout amount. Option C is incorrect as the insurance company pays the amount after the deductible, not more than the claim amount. Option D is incorrect because the deductible is not added back to the payout amount. It is subtracted. Question 4. Which of the following is a key difference between an HMO, health maintenance organization, and a peer preferred provider organization? A. PPOS generally require referrals from primary care physicians for specialist visits, while HMOs do not. B. HMOs offer more flexibility in choosing healthcare providers, while POS require you to see in-network providers for maximum benefits. C. PPOS provide care only within a limited network of providers, whereas HMOs provide care outside their network at a higher cost. D. HMOs typically have higher premiums than PPOS due to the limited provider network. Answer. B. HMOs offer more flexibility in choosing healthcare providers, while POS require you to see in-network providers for maximum benefits. Explanation. An HMO requires its members to choose a primary care physician PCP and typically needs a referral from the PCP to see specialists. Members must seek care from providers within the HMO network for coverage to apply, and there is limited out-of-network coverage. In contrast, Appeal provides more flexibility in choosing healthcare providers, including the option to see specialists or out-of-network providers without a referral, but typically offers low benefits for out-of-network care. Option A is incorrect because HMOs require referrals for ECPS for specialist visits near PPOS. Option C is inaccurate because PPOS offer more freedom in choosing out-of-network providers, unlike HMOs. Option D is not necessarily true, since HMOs generally have low premiums due to the restricted provider network. Question 5. Under California law, if an insurance producer is found guilty of engaging in unfair claims settlement practices, what is one potential penalty they could face? A. The fine of up to $5,000 per violation. B. Suspension or revocation of their insurance license. C. Permanent disqualification from working in the insurance industry. D. A reduction in the amount of commission they can earn. Answer: B. Suspension or revocation of their insurance license. Explanation: California law prohibits unfair claims settlement practices under the California Insurance Code. An insurance producer who engages in such practices could face severe penalties, including suspension or revocation of their insurance license, as it undermines the integrity of the claims process and harms consumers. Option A is incorrect because the penalty typically involves suspension or revocation, not a fine alone. Option C is too severe a penalty for unfair claims practices. Producers can regain their license through corrective actions, but permanent disqualification is rare. Option D is incorrect because commission changes are not usually tied directly to unfair claims practices. Question 6. Which of the following is true regarding the concept of insurable interest in an insurance contract? A. An individual can have insurable interest in any property they want to insure. B. Insurable interest must exist at the time the policy is issued but does not need to be maintained after the policy is in force. C. Insurable interest ensures that the insured has a legitimate financial interest in the subject of the insurance. D. Insurable interest is not required for life insurance policies. Answer: C. Insurable interest ensures that the insured has a legitimate financial interest in the subject of the insurance. Explanation: Insurable interest is a fundamental concept in insurance that requires the policyholder to have a legitimate financial interest in the property or life they are insuring. This concept prevents individuals from purchasing policies on things in which they have no financial stake, thus avoiding speculative or gambling behavior. Option A is incorrect because insurable interest must be established in the property or life being insured. Option B is wrong as insurable interest must exist both at the time of policy issuance and at the time of a claim, especially for life insurance. Option D is incorrect because insurable interest is required for life insurance policies as well. Question 7 scenario: Mrs. Rogers has a homeowner's insurance policy that includes coverage for both fire and theft. Her house is burglarized and the thieves steal several valuable items. After filing a claim, she learns that some of her stolen items are not covered because they are listed as exclusions in the policy. Which of the following is the most likely reason some items were excluded from coverage? A. The items are not specified in the insuring agreement. B. The items are not considered personal property under the policy. C. The items fall under the exclusions for high-value items like jewelry and artwork. D. The items were damaged before the theft occurred and not during the incident. Answer: C. The items fall under the exclusions for high-value items like jewelry and artwork. Explanation: Many homeowners' insurance policies contain exclusions for specific high-value items such as jewelry, artwork, collectibles, and other valuables. In these cases, the policyholder would typically need additional coverage, like a rider, to fully insure such items. Option A is incorrect because while exclusions are important, it's more likely that high-value items were excluded due to specific causes in the policy. Option B is incorrect because personal property is typically covered unless excluded, but specific exclusions for high-value items apply. Option D is irrelevant since the items were stolen and not damaged before the theft. Question 8. What does the law of large numbers state about insurance and risk? A. The greater the number of people or risks involved, the more predictable the loss experience comes. B. Insurance companies must provide equal coverage to all policyholders to ensure fairness. C. A larger number of policyholders increases the chances that each policyholder will experience a claim. D. Larger pools of risk create less uncertainty for insurance companies. Answer A. The greater the number of people or risks involved, the more predictable the loss experience becomes. Explanation: the law of large numbers is a principle in insurance that states the more people or risks involved in a pool, the more predictable the losses will be for the insurer. This law enables insurance companies to calculate premiums more accurately because they can predict overall loss experience more reliably. Option B is incorrect, as equal coverage for all doesn't directly relate to the law of large numbers. Option C is incorrect because it is not about the likelihood of each individual claim, but rather the predictability of total claims for the insurer. Option D is incorrect, as larger pools of risk provide more predictability but still carry uncertainty. Question 9. Which of the following is true about the contestability period in a life insurance policy? A. The insurer has the right to contest a claim if the policyholder dies within the first 2 years of the policy. B. After the contestability period, the insurer can never contest a claim regardless of the circumstances. C. The contestability period begins once the beneficiary files a claim. D. The insurer may contest a claim for misrepresentation only after 3 years have passed. Answer A. The insurer has the right to contest a claim if the policyholder dies within the first 2 years of the policy. Explanation: the contestability period is typically the first 2 years of a life insurance policy. During this time, the insurer can investigate and contest claims based on material misrepresentation or omissions in the application. After this period, the insurer generally cannot contest the policy except in cases of fraud. Option B is incorrect because contestability may still apply in fraud cases. Option C is incorrect because the contestability period starts from the policy issuance, not from when the claim is filed. Option D is incorrect because the standard contestability period is 2 years, not 3. Question 10. Which of the following is a key feature of a named peril policy? A. It covers all types of risks, regardless of whether they are specifically listed. B. It covers only the risks or perils explicitly listed in the policy. C. It offers a broader scope of coverage than a more risk policy. D. It requires additional endorsements to cover natural disasters. Answer B. It covers only the risks or perils explicitly listed in the policy. Explanation: a named peril policy only provides coverage for risks or perils that are specifically named in the policy. If a peril is not listed, it is not covered under the policy. This is in contrast to an all-risk or open peril policy, which provides coverage for all risks except those specifically excluded. Option A is incorrect because named peril policies do not cover all types of risks. Only the listed perils are covered. Option C is incorrect because named peril policies are more restrictive than all-risk policies. Option D is incorrect since natural disasters would only be covered if explicitly listed in a named peril policy, not automatically. Question 11. Which of the following is true about the replacement cost coverage in property insurance? A. It reimburses the insured for the actual cash value of the property at the time of the loss. B. It covers the full cost to repair or replace property without factoring in depreciation. C. It is only available for personal property, not for real property. D. It is limited to the market value of the property at the time of the loss. Answer B. It covers the full cost to repair or replace property without factoring in depreciation. Explanation: replacement cost coverage reimburses the insured for the full cost to repair or replace property with new materials of like kind and quality without deducting for depreciation. This type of coverage helps the policyholder recover the full value of the property lost, which is an advantage over actual cash value SEV policies that account for depreciation. Question 12. In which situation would an umbrella insurance policy typically apply? A. When a driver causes an accident that results in damages exceeding their auto insurance policy limits. B. When the policyholder's home sustains damages from fire. C. When the insured's life insurance policy expires. D. When the insured files claim for theft of personal property under their homeowner's policy. Answer A. When a driver causes an accident that results in damages exceeding their auto insurance policy limits. Explanation: umbrella insurance is designed to provide extra liability coverage above and beyond the limits of standard auto, homeowners, or other personal insurance policies. It would apply in cases where the damages exceed the coverage limits of the underlying policy, such as in an auto accident. Question 13. Which of the following types of insurance covers professional negligence? A. General liability insurance. B. Errors and omissions insurance. C. Property insurance. D. Workers' compensation insurance. Answer B. Errors and omissions insurance. Explanation: errors and omissions (EO) insurance is designed to protect professionals such as doctors, lawyers, or consultants from claims made by clients for negligent acts, errors, or omissions in the services they provide. This insurance does not cover physical damage, but rather covers legal and defense costs in case of claims of professional negligence. Question 14 scenario: after Hurricane Henry, a policyholder discovers that their home's roof has been damaged by falling debris, but they didn't have windstorm coverage in their homeowner's policy. What type of endorsement or coverage should the policyholder consider to prevent this issue in the future? A. Flood insurance. B. Windstorm or hurricane endorsement. C. Earthquake coverage. D. Personal property endorsement. Answer: B. Windstorm or hurricane endorsement. Explanation: in this case, the damage caused by the hurricane is related to wind, which is typically excluded from standard homeowners policies unless a specific windstorm or hurricane endorsement is added. By adding this endorsement, the homeowner can ensure coverage for damages caused by wind or hurricanes. Question 15. Which of the following statements about a deductible in an insurance policy is correct? A. It is the amount the insured must pay before the insurer begins to pay for a claim. B. It is the portion of the claim that the insurer is responsible for paying. C. It is the amount the insured must pay for additional coverage. D. It is the amount the insurer pays for a claim excluding the insured's share. Answer: A is the amount the insured must pay before the insurer begins to pay for a claim. Explanation: a deductible is the amount the insured must pay out of pocket before the insurance policy begins to pay for a claim. Higher deductibles typically lower premium costs, while lower deductibles result in higher premiums. Question 16. Which of the following is an example of a peril covered under a typical homeowner's insurance policy? A. Earthquake. B. Flood. C. Theft. D. Wear and tear. Answer: C. Theft. Explanation: a typical homeowner's insurance policy covers perils such as fire, theft, vandalism, and certain natural disasters such as windstorms, but it generally excludes coverage for earthquake and flood unless additional endorsements or policies are purchased. Wear and tear is also excluded from coverage. Question 17 scenario: John's car is involved in an accident and he is found to be at fault. His auto insurance policy includes bodily injury liability and property damage liability. Which of the following would be covered under his bodily injury liability? A. Damage to John's car. B. Medical expenses of the passengers in his car. C. Medical expenses of the other driver and passengers. D. Damage to the other vehicle. Answer: C. Medical expenses of the other driver and passengers. Explanation: bodily injury liability covers the medical expenses, lost wages, and other costs associated with injuries sustained by others in an accident where the insured is at fault. It does not cover damages to the insured's own property or injuries to the insured and their passengers. Question 18. Which of the following types of coverage would an insurance company offer to protect a business from the loss of income due to a disaster? A. Business property insurance. B. Business interruption insurance. C. General liability insurance. D. Professional liability insurance. Answer: B. Business interruption insurance. Explanation: business interruption insurance, also known as business income insurance, covers the loss of income a business may suffer due to a disaster such as a fire or natural catastrophe that disrupts the company's operations. It helps replace lost income and pay for necessary operating expenses while the business is temporarily closed. Question 19. Which of the following would most likely be covered by a personal liability policy? A. A person's personal injuries caused by slip and fall at their home. B. Medical expenses for the insured in an auto accident. C. Legal defense costs if the insured is sued for negligence. D. Damage to the insured's home caused by hurricane. Answer: C. Legal defense costs if the insured is sued for negligence. Explanation: personal liability insurance covers the insured if they are legally responsible for causing bodily injury or property damage to others. It typically pays for legal defense costs and settlements if the insured is sued for negligence or other personal liability issues. Question 20. Under the Affordable Care Act (ACA), which of the following is true regarding health insurance coverage? A. Health insurance companies cannot deny coverage for pre-existing conditions. B. Health insurance plans can charge high premiums for older adults. C. Health insurance coverage is no longer mandatory for most individuals. D. Health insurance premiums are determined solely by the insured's medical history. Answer A. Health insurance companies cannot deny coverage for pre-existing conditions. Explanation. Under the ACAT, health insurers are prohibited from denying coverage or charging higher premiums based on pre-existing conditions. This reform ensures that people with existing health issues can still obtain affordable health insurance. The ACAT also mandates that most individuals to have health coverage, though there are exceptions and premiums are not based solely on medical history. Question 21. Which of the following is a characteristic of a whole life insurance policy? A. It provides coverage for a specific term such as 20 years. B. It offers permanent coverage with a savings component. C. It only pays benefits if the insured passes away during the term. D. It does not accumulate any cash value over time. Answer B. It offers permanent coverage with a savings component. Explanation. Whole life insurance provides permanent life insurance coverage and includes a savings or investment component that builds cash value over time. The policy remains in force as long as premiums are paid and the cash value can be borrowed against or withdrawn under certain conditions. Question 22 scenario. Emily has a health insurance policy with a $500 deductible and 80/20 coinsurance. After surgery, the total medical bill is $10,000. How much will Emily need to pay out of pocket? A. $500. B. $2,000. C. $3,000. D. $2,500. Answer D. $2,500. Explanation. First, Emily pays her $500 deductible. After that, the insurer covers 80% of the remaining $9,500, $10,000. $500, which is $7,600. Emily is responsible for the remaining 20% or $1,900. The total amount Emily pays out of pocket is $500 deductible plus $1,900 coinsurance, totaling $2,500. Question 23. Which of the following best describes uninsured motorist coverage? A. It covers medical expenses for the insured if the driver at fault is uninsured or underinsured. B. It covers the cost of repairing an insured vehicle after an accident. C. It covers the legal fees for defending a driver involved in an accident. D. It covers the costs of medical treatment for a pedestrian involved in an accident. Answer A. It covers medical expenses for the insured if the driver at fault is uninsured or underinsured. Explanation. Uninsured motorist coverage helps pay for medical bills, lost wages, and other costs if the insured is involved in an accident caused by a driver who doesn't have sufficient or any insurance coverage. This protection helps the insured cover costs that would otherwise not be paid due to the at-fault driver's lack of insurance. Question 24. Which of the following is a primary purpose of a liability insurance? A. To pay for the replacement of damaged personal property. B. To protect against claims arising from bodily injury or property damage to others. C. To cover medical expenses for the insured individual. D. To provide cash value accumulation for the insured. Answer B. To protect against claims arising from bodily injury or property damage to others. Explanation. Liability insurance protects the insured from financial loss due to legal claims or lawsuits for bodily injury or property damage caused by the insured's actions or negligence. This type of insurance is common in auto, homeowners, and business policies. Question 25. What is the purpose of collision coverage in auto insurance? A. To pay for injuries sustained by the driver during an accident. B. To cover the cost of repairs to the insured's car after an accident, regardless of fault. C. To cover damage caused by vandalism to the insured's car. D. To reimburse the insured for medical expenses caused by a car accident. Answer B. To cover the cost of repairs to the insured's car after an accident, regardless of fault. Explanation. Collision coverage pays for the damage to the insured's car caused by a collision with another vehicle or object, regardless of who is at fault. It does not cover injuries or damages caused to other vehicles or property, which would be covered by liability insurance. Question 26. Which of the following statements about term life insurance is true? A. Is permanent life insurance that covers the insured for their entire life. B. It provides coverage for a specified term such as 10, 20, or 30 years. C. It includes a savings or investment component that builds cash value. D. It typically has higher premiums than whole life insurance for the same coverage amount. Answer B. It provides coverage for a specified term such as 10, 20, or 30 years. Explanation. Term life insurance provides coverage for a set period such as 10, 20, or 30 years and does not build cash value. It is generally more affordable than whole life insurance but only provides a death benefit if the insured passes away during the term of coverage. Question 27. Which type of insurance would a business owner most likely need to protect against claims of negligence in professional services provided to clients? A. Workers' compensation insurance. B. Professional liability insurance, errors and omissions insurance. C. General liability insurance. D. Business property insurance. Answer. B. Professional liability insurance, errors and omissions insurance. Explanation. Professional liability insurance, also known as errors and omissions (EO) insurance, protects businesses and professionals from claims of negligence, errors, or omissions in the services they provide to clients. This type of insurance is especially important for those in professional services like law, accounting, or consulting. Question 28. Which of the following is true about medical payments coverage under a homeowner's insurance policy? A. It covers medical expenses for the insured and their family members if injured on their property. B. It covers medical expenses for visitors injured on the insured's property, regardless of fault. C. It covers medical expenses for the insured's pets in case of injury. D. Is a mandatory coverage under all homeowners' policies. Answer. B. It covers medical expenses for visitors injured on the insured's property, regardless of fault. Explanation. Medical payments coverage under a homeowner's policy covers medical expenses for guests or visitors who are injured on the insured's property, regardless of fault. It does not cover injuries to the insured or their family members or injuries caused by the insured's pets. Question 29. Scenario. Sarah's homeowner's insurance policy has $1,000 deductible. After break-in, her policy covers the damage to her property and personal items, totaling $5,000. How much will Sarah receive from her insurance company? A. $4,000. B. $5,000. C. $1,000. D. $6,000. Answer. A. $4,000. Explanation. The deductible is subtracted from the total claim amount. In this case, the damage totals $5,000, but Sarah has a $1,000 deductible. Therefore, she will receive $5,000. $1,000 equals $4,000 from her insurance company. Question 30. Which of the following best describes underinsured motorist coverage? A. It provides coverage for the insured's vehicle if it is damaged in an accident with an underinsured driver. B. It pays for medical expenses for the driver and passengers if the at-fault driver has inadequate insurance coverage. C. It covers the cost of legal defense in the event of lawsuit. D. It covers the cost of repairs to the insured's vehicle after collision, regardless of fault. Answer. B. It pays for medical expenses for the driver and passengers if the at-fault driver has inadequate insurance coverage. Explanation. Underinsured motorist coverage protects the insured in situations where the driver responsible for the accident has insufficient insurance to cover all of the damages. It typically covers medical expenses, lost wages, and other costs incurred due to the accident.